Okay, so good evening, everyone. Thank you for joining our webinars today. Hope every one of you are doing well. So my name is Shereen from Phillip Futures Marketing, and I will be the MC for today. So during the webinar, if you have any questions, to type them into the question box, and I will address the questions during the Q&A sections at the end of the webinars. Before we introduce our speaker, please allow me to introduce our company. Okay, so as usual, I need to emphasize on our disclaimer where this presentation has not been reviewed by Security Commission Malaysia and is provided to you solely for general information and does not constitute any recommendations. We are not liable for any losses arising based on these informations. Investments are subject to investment grade. Therefore, you shall seek for advice from quality advisory before making any investment decisions. So Phillip Futures is a wholly owned subsidiary of Phillip Capital Holdings Sdn Bhd. It is incorporated on 7th of October 1995. Our headquarters is in Kuala Lumpur and branches distribute across Malaysia, such as Kota Damansara, Malacca, Penang, Johor, Kuching, and also our new branch at Kota Damansara and Cebu. Other than that, Phillip Futures is the trading participant of Bursa Malaysia Derivative Berhad, clearing participant of Bursa Malaysia Derivative Clearing Berhad, and also holder of Capital Market Service License, which is known as CMSRL. Next, I would like to take this opportunity to extend our gratitude behalf of my company, Phillip Futures, to our clients. With you, we are unable to achieve the rewards. So in 2020, we achieved 3 rewards from Bursa Malaysia: the best overall, best retail, and best institutional derivative trading participants. Our mother company, which is Phillip Capital, have office and branches over 14 different countries. So for futures, we cover not only product in Malaysia, we all cover from different exchange, the exchange such as Singapore Exchange, CME, CBOT, NYMEX, and more. With our strength of global coverage, clients are able to trade both local and foreign products under the same platform. Next, so what is the product which is available in Phillip Futures? So Phillip Futures are mainly focused on product offering, which is futures contracts and our contract for difference, which is called as CFD. So next, why should you choose Phillips? So first of all, we will provide advisory service such as enquiries. Next, we will provide wide range of products for futures that enable clients to trade both local and foreign products. Other than that, we will send out latest market news and commentaries to clients every day through email for your reference. Lastly, our headquarters have 24 hours brokering and execution support. This is important for clients who trade foreign futures, and also dealer can assist you enquiries anytime. So next, I would like to introduce Ken On, which is the Vice President of Sales Department for Eurex Derivative Market Trading. Without further ado, let us welcome Trent to introduce for the introduction to Eurex.
Thanks, Seren. Good evening, everyone. Thank you for attending the webinar by Phillip Futures and Eurex. My name is Ken, Eurex Sales Lead based in Singapore. Today, I would like to take a few short words on Eurex and our products. Eurex is a leading European derivative exchange based in Frankfurt, Germany, but with offices all over the world. Our benchmark product, STOXX 50, is the leading blue chip index for Eurozone. Index covers 50 largest and most liquid companies in Eurozone country. Companies such as Adidas, Allianz, BMW, BNP Paribas, etc. STOXX 50 future and option are the most heavily traded product at Eurex. Approximately average daily volume is about 1.9 million. As for DEX, The leading Germany equity index cover 40 largest companies such as S&P, Deutsche Bank, Volkswagen, etc. Average daily trading volume is about 120,000. In December 2018, driven by the client demand, we extended our trading hour of a Euro STOXX 50, DAX, and mini DAX future into the Asian hour as our first phase of having our product available around the clock. The extension of trading hour also included our fixed income product like the Bund Bubble Shark, as well as over 100 MSCI future. This means the trading hour of our benchmark product is now 21 hours, starting at 8 morning Singapore time. Last year in December 2020, we moved to the phase 2 of our trading hour extension and extended additional products such as 10-year Europe, Euro STOXX Bank, STOXX Euro 600, and VSTOXX Future. VSTOXX Future is the volatility index of Europe. Still in part of phase 2, to cater the global participant, we successfully launched micro futures contract for Euro STOXX 50, DAX, and SMI in April 2021. Why micro future? The micro contract are the 5 times smaller than the mini contract and 10 times smaller than the regular contract. Micro future product provide the exact hedging tool for global investor. Small contract size and low margin requirement. At the same time, Eurex, we are giving free market data for the new private investor. Once again, thanks everyone for your time. Hope you will enjoy the presentation by Daniel, and over to you, Sherin. Thank you.
Okay, so thank you, Ken, for the introduction to Eurex. Next, I would like to do an introduction on our speakers, which is Daniel Ng. Daniel Ng has been started his career trading commodities futures back in 1985. He went on to be a gold trader in 1998 before joining Untitled Chapter in 1992, where he traded mostly US futures as well as FX, and become one of their vice presidents. So he is currently contracted to the CME Group as an independent speaker for the Asia Pacific regions as well as for the Frankfurt-based Eurex. He also the author of the Accidental Traders, a book available at major bookstores in both Singapore and Malaysia. So without further ado, let's invite Mr. Daniel to start his sections.
Thank you very much, Sherin. Hope you guys can hear me, and a very good evening to all of you. Today is probably the last webinar we'll be doing for this year because we are already into the tail end of the year. And the last time I saw you, I think was back in possibly 2 months back. And today we're going to spend some time to talk about the European markets. Why are we talking about European markets? Because the whole world, predominantly when you trade international investment products, we are mostly focused on the US. However, the European market is also a very big market. These 19 nations that make up the Eurozone actually is the second largest economic bloc in the world. So that means it is also a major market, and of course the markets over there will also be quite influential. Okay, going into 2022, I think there's going to be a lot of things going to come out from Europe, and I think it's about time that we shift our focus not only to the United States, we also want to look at the Eurozone as well. And today we'll be, of course, talking about predominantly the equity index. Like what Ken has mentioned, there are new products being launched by Eurex, and these are tailored towards the retail investors and especially to those in Asia. We all know the time zone between Europe and Asia is actually more conducive for trading as compared to the US markets, because we are about currently 13 hours ahead of Europe, but less than that for the European market. So there's a great overlap between the active trading hours for Asia as well as Europe. Now, what we're going to talk about today is going to be the main driver as to what I think is going to happen or what has been happening in the Eurozone and what is likely to be the main driver for the European market going forward, and how are we going to be able to take advantage of the opportunity presented by the volatility in the European markets for trading. Okay. Earlier on, Shireen has actually covered the disclaimer, so I will not be talking about this again. However, I would like to reinforce that opinions that you're going to hear from me are those of mine, and definitely it has got nothing to do with Eurex, got nothing to do with Phillip Futures. They are all my personal opinion. So please do not trade based on this information alone. So if you do, make sure that you are aware of the risk involved. Okay. Now, to begin with, let's take a look at the overall economic performance of the European zone. Okay, the 19 nation that shares the one common currency called the euro is actually traded as a block. Okay, so the GDP for the entire eurozone, sometimes called the euro area, okay, has been we can see from the chart on the left the GDP for itself for the year. We can see that the GDP did very well in Q2 of this year. However, the Q3 number has been less than stellar because you can see that the GDP has climbed down from its peak in the middle of the year. So going forward, the trajectory that doesn't look fantastic for Eurozone as well. Okay, so we are seeing decreased economic activity. So this could be a concern for the market going forward. Okay, so just keep this in mind. You can see there are two color bar here. We have one in orange, which denote Germany GDP. The other one, of course, is the EU, which is the bright blue color bar. Okay, you can see overall the Eurozone itself has been doing a lot better, but Germany being the largest economy within the Eurozone, of course, we also want to monitor the performance of the Germany economy. You can see the Germany economy have actually started to go down in terms of when you compare it to Q2 performances. Okay, then on the right you can see that there's a market purchasing managers index. Okay, why are we concentrating on this particular index? Because Europe as a whole, especially Germany, is a major manufacturing powerhouse. Okay, we all know Germany produce a lot of high-end continental cars, for example, the BMW, the Mercedes-Benz. So also in terms of high-tech medical equipments, you can see Germany is actually a major powerhouse. So we want to monitor the manufacturing index, and from here we can see the the index itself has also been coming down. Okay, so this is a concern for us because you can see compared to the middle of the year or even the first quarter of this year, you can see that the manufacturing for Germany has been on a downward curve. Okay, lately you can see it has been stabilized above 57.6. Anything above 50 is considered good, but you can see that it has been climbing down consistently since the first quarter of this year. Likewise, the other major economy within the Eurozone is France, of course. Even France is also seeing the same kind of curve. Okay, and of course the French market is not as strong as the German market, but you can see that overall, when you compare the two largest economies within the Eurozone, you can see that they have the same kind of curve. Okay, meaning to say that overall the economic activity within the Eurozone, in particularly to Germany as well as France, has been on the back foot of late. Okay, now the other major theme that we have been talking about since March of this year has been the elevated inflation. So inflation has been a theme and is going to be a theme going forward into 2022. Are we going to see higher inflation going into the new year? I think the writings are already on the wall. The drivers that have been driving the high inflationary environment in which we are in is still around. And I think it's going to get even more severe as we go into the new year. Now, on the left, you can see there's a producer prices. Of course, this reflects the input cost of all the producers. Okay, so you can see again, we have two color bar here. We have the orange as well as the blue, and orange refers to Germany. You can see that the cost, the input cost for the Eurozone as well as Germany has been on the up and up. Okay, and this is the latest number we have for October of this year, and you can see that the number is at the year's high. Okay, so these numbers mean to say that so long as your input costs more, definitely producer is going to pass on those costs to the retail market. So the consumer will have to bear the higher and elevated input costs. Okay, we can see that a major a major component of the input cost increase has got to do with the global disruption in the supply chain. So when you have supply chain issue, things become more scarce, and prices will definitely have to find its level at a higher levels. Okay. Likewise, we also have an energy crisis right now. The whole of this year, we can see the energy prices has been, rising, and of course, earlier on in the year, the reason why energy prices goes up is because they think that the COVID-19 situation has been controlled, and the global market is opening up. Things seems to be going better. So it's basically based on demand. But of late, you can see that the global supply chain has also hit the energy markets. And of course, on top of that, we have geopolitical tension, and something that I will talk a bit later on, which also caused the energy prices to remain at the elevated prices. So all this means the consumer prices will have to go up because the input cost has gone up. So the consumer's price would definitely have to follow through. Now, on the in the chart on the right, we have again two color bars. One is the white Germany index. The other one is the Eurozone CPI index. Of course, this one refers to the consumer prices at the retail end. You can see that, again, this is the latest number for November. You can see that the numbers are actually quite high. In fact, for Germany, this is the highest in 29 years. Okay, and for Eurozone, since the euro has been launched, you can see that this is about the highest inflation at the retail level that we can see so far. So this is very, very serious. However, there is a bit of a difference between how the central banks react to the high inflationary pressure compared to the, let's say, the ECB. And because the two central banks has very different take on how to tackle the inflationary issue, there lies the risk that we are going to see. There is what we are seeing right now is actually a policy divergence between the Federal Reserve and the ECB, and against the other major central banks such as the BOJ or even the BOE. And so this will cause a slight difference in how capital moves globally. Now, this is an article that came out at the end of last month, which is about 2 weeks, less than 2 weeks ago. Okay, it says that German inflation is at the highest in decades, and this is a reflection of what we have seen earlier on in the chart. The harmonized index for consumer prices actually reflects a very elevated kind of prices, and you can see from this particular report here from Reuters that the whole of Eurozone as well as Germany are seeing very, very high inflation. Things are at a level they have not seen for quite some time. Okay, for Germany, it's 29 years high. So this is, like I said earlier on, something that we all have to watch out. How the central banks dealing with this particular issue will determine how the market will react going forward. Now, this is, of course, Christine Lagarde, the current ECB president, and what she is trying to tell the world is that she don't believe that the inflation that we are seeing in the whole of Eurozone is something that she is too concerned about. She believes that this is actually the peak, and going into the 2022, we should see lower inflationary pressure. And now this goes against the grain of most analysts, because the numbers have not shown that the inflationary pressure has already peaked. Okay, it may well have peaked, okay, but right now we are not seeing that curve yet. What we are seeing is the inflation curve is beginning to starting to go parabolic. So this is a major concern here. What we are most concerned as traders and investors is that is the ECB taking a more laid-back situation, or is it because they have run out of policy tool? We all know Eurozone has zero interest rates. Okay, for their deposit rates, they are actually negative 0.5. When you compare that with the Fed fund rate at just above 0.25, you can see that there is currently a disparity between the interest rates in the Eurozone as well as the United States. And if this thing continue, because the Fed has already mentioned that they are going to start, or in fact, they have already started to slow down the asset purchases in a program what we understand as QE. The Federal Reserve has started slowing down the QE program. Okay, meaning to say they are purchasing less and less and less. Okay, since November last month. Okay, whereas the ECB says that, okay, they have two major programs that are currently running, which are asset buying. Okay, one was actually started back in 2014. Okay, and that was also the time whereby they experimented with negative interest rates. So that program, okay, is going to end in March next year. Okay, so unlike the Fed, they are slightly behind the curve. What we are more concerned is that they are not looking to raise interest rate, unlike the Federal Reserve, which has already telegraphed to the world that they are going to look at hiking interest rates after the QE program has come to an end, and which likely to happen in the middle of next year. So thereafter, we should be looking to see whether the Federal Reserve will follow through on what they have told us, that they are going to start to hike interest rate. And if that happens, we can see that the interest rate divergence is going to get broader and broader. What is going to happen is that funds from Europe is likely to shift from Europe to the United States, because financial companies such as banks and pension funds, they need to find a yield at negative interest rate or even zero interest rate in the Eurozone compared to a rising interest rate environment in the States. It doesn't take rocket scientists to understand that the money is in the US. So if you are a financial institution in Eurozone, having to suffer zero interest rates or even negative interest rates, you will do the logical thing. You will open up a branch in the United States and park your money into Europe. Back into the US. So as more and more capital move from the Europe to the US, it will affect a lot of asset classes. It will first obviously will affect the euro versus the dollar rate. Okay, dollar is definitely going to rise, and euro is definitely going to move lower. Okay, as a direct impact of this divergence. We are also likely to see more and more people rushing into US equity relative to European equities. So that could be the most straightforward impact that we can see. Now over here we can see that about 2 weeks ago, exactly 2 weeks ago, we have a minor shock. 2 Thursdays ago, which is the day after Thanksgiving in the United States. Okay, the Omicron become a major headline. The Omicron, of course, is the new variant that comes out from South Africa, and because it is such a new variant, it's supposedly very highly infectious. Whether it is even more lethal, we do not know. Okay, but when the news came and hit a wire, the market reacts to the downside. And not only equities do see a sharp pullback, we can see that crude oil prices also fall back. They fall back by more than $20 per barrel in a very short period of time. Okay, over here you can see the peak was $85.41 in the WTI, and it fell very swiftly to $65, just above $65, before rebounding back. This afternoon, I take a look, it's at $73.22. Okay, so again, we can see that this is an unexpected bonus, because one of the main drivers for the inflation that we are seeing is high energy prices. So when crude oil prices started to fall from $85 down to $65, that actually relieved the market of that pressure for a while. Now it looks like oil prices has rebounded. Whether you will go back and challenge a high, we do not know, but I think there's a very good likelihood that high energy prices is here to stay, because at the end of the day, we are moving into winter, and during winter, obviously, we're going to see more people turning on the heater, and if the tension between Russia and Ukraine end up in a shooting war, that is going to see a major play on the crude oil prices. So just be on the lookout for energy prices, because it will impact the inflation outlook. Okay, now, okay, what am I doing here? Now here, earlier on I did mention what the Federal Reserve. Let's take a look at what the Federal Reserve is doing, because the major central bank right now we want to watch, okay, is to make sure that we don't keep our eyes away from what the Federal Reserve is doing. So far, the Federal Reserve has mentioned a few things. Okay, so look, they are going to start to hike interest rates. Okay, we have interest rates. The Fed fund rate right now is just above the zero mark. Okay, 0.8. Okay, 0.08 actually. Okay, we can see that the interest rate is almost at zero, and one of the things that they are looking to tackle the inflationary front is to high interest rate. That has already been told to us, and the market do expect at least 2 hikes next year, okay, of a 25 basis point each time. Okay, the other thing that the Federal Reserve has already done, okay, has, like I said earlier on, they have started to slow down the asset purchases. Before November, they were buying on the average $120 billion in terms of assets, whether it is treasury bills, treasury bonds, or mortgage-backed securities. Now it seems that they are slowing down. You can see that November, they have slowed down from 120 billion down to 100 billion. This month, they're going to look to cut down another 15 billion in terms of purchases. So they are already doing something on this front as far as the QE program is concerned. So this is what the Federal Reserve is doing. When you compare that to what the European Central Bank is doing, then you can see the contrast here. Okay, when you can see here is that interest rates in the Eurozone is officially 0, okay, and the deposit rate is negative 0.5. Let me just say that in the Eurozone, we're either seeing 0, if not, when you compare against the deposit rate, which is negative, then you can see a very clear-cut divergence. The United States has not started to hike interest rate yet, but if they do, the gap between the European rates and the US rate is going to get wider. Okay, and when that happens, capital is going to move from where the interest rate is low to where the interest rate is higher, because capital always need to find a yield, a better yield. Okay, so this is a very natural flow of market, economics. The other thing is QE in the Eurozone. Okay, like I said earlier on, they have 2 basic programs. One is called the asset purchases, which is APP, which actually started in 2014, and it was also that year in which they experimented with negative interest rates. It did not work. Okay, so the APP has been ongoing. Last I checked, of late, the program has actually moved downwards to about $20 billion. Okay, so this is nothing compared to the other program which they launched at the height of the pandemic. The other thing is called a PEPP, Pandemic Emergency Purchase Program. That one is the behemoth. Okay, that one is in the $1.85 trillion compared to 20 billion in the APP program. Okay, so you can see that by March of next year, the ECB says that they're going to wind down the APP program, but keep the PEPP program alive. So in other words, the QE program in the States, in the Eurozone is going to continue. Okay, so they have already said that there is no way they're going to hike interest rate in the whole of next year. So we shall see, because at the end of the day, they could be superseded by events. Okay, so far the stand is that they are not going to raise interest rates, and the way we look at it is this: the ECB really have no choice. They are right now stuck in a hard rock and a cliff. Okay, because interest rate at negative cannot hold up the economy. In fact, the GDP numbers which I show you in the earlier slides, it seems that since the Q2 of this year, the economy is losing steam. Okay, the growth in economic growth, whether it's in Germany or whether it's in the Eurozone itself, is losing steam. So they cannot afford to high interest rate, because when they high interest rates, they're going to blow up the national debt, because the QE program is still concurrently running. Okay, so this is what we are seeing. There is a divergence between the policy pursued by the Federal Reserve and those that are pursued by the ECB. Now, what is going to be the impact? Like I said earlier on, the impact will be quite profound. Not only on the currency front, it's going to be also on the various debt instruments, whether it's the Euro bonds versus the US Treasury, or more directly in our context here will be how will the equity market react in Eurozone relative to those in the States. Okay. Now, Jen Whiteman actually is going to resign at the end of this month. He is the current Deutsche Bank president, okay, which is the central banks in Germany, and he has always been at loggerhead with the policy pursued by the ECB, because Germany have experienced hyperinflation during in the aftermath of World War I. So they are very, very, very scared of inflation. So they have always been very conservative. They do not want to pursue loose monetary policy. unlike those pursued by the previous ECB president, which is Mario Draghi. Okay, and now of course the baton has been passed on to Christine Lagarde. Okay, both have been pursuing very loose monetary policy, much to the anguish of the German central banks. And I think he's giving up, and he says he's going to resign at the end of this month. Okay, so Germany is definitely not in favor of the loose monetary policy pursued by the ECB. Now, all this will lead to the main thing that we're going to talk about. How are we going to take advantage of all this likely movement in the European equity via these two products? Now, these two products has only recently been launched. We're talking about a Eurex micro equity index futures. Okay, predominantly we're talking about a Euro STOXX 50, which is a Europe-wide stock index. Okay, mixed up of a combination of French, German company, and a few other major companies that are listed within this index itself. And this is by far one of the most majorly traded index in Europe itself. Okay, so the micro equity index, earlier on Ken did mention, it has been designed, okay, to make it very accessible to investors worldwide. You can see that the extended trading hours that they have, actually 20%, about 20% of the volume actually come from Asia. So you can see that the participation rate in Asia, we have noticed the availability of such a product, okay, and this product has been very successful since the day it was launched. Okay, it was only launched this year. You can see that the volume traded is superlative. Later on, I'll show you a volume chart to show you how popular these two products is. The other one, of course, we're talking about the DAX, which is the German index, which is very similar to the Dow Jones, which is the bluest of blue German stocks. Okay, both equity index are now available in the micro equity index futures, and you can see that the contract spec itself, it is very, very affordable. Okay, in terms of the multiplier is whatever the index you can see, you times by €1, that will be the value. Okay, so it is very accessible. We want to take a look at this because it allows us to have different kind of play. Previously, it is very difficult to participate in European equity index futures because the contract size is definitely not geared towards people like you and me. Okay, but they have very good timing. Okay, they realize that especially in the current situation we are in, okay, there's going to be a lot more volatility going on in equity markets around the world. So they have launched these products. Okay, I think with an eye with the global market in which they want to offer these products. Okay, so you can see that the margin requirement, of course, this margin requirement is not cast in stone. Depends on volatility. If the volatility spikes, of course, the margin required will be increased. But the last I checked was only €356 for the Euro STOXX 50 and €1,446 for the DAX 30. Okay, here I did not show you the intraday. You will have to check with your broker what are the intraday margin requirements for these products here. So they are definitely geared towards you and me. Now, this is the volume. You can see that there are two colored bars here, one in the dark blue and one in the light blue. The one in the light blue reflects the trading volume for DAX. You can see that the average trading volume, you can see the whole of November, okay, we just ended about 9 days ago. You can see it hit 500,000 contracts. Okay, so this is a fantastic product because the volume has been climbing since the day it was launched. Okay, the Euro STOXX 50 did not actually follow through with the same kind of curve as we can see in the DAX, but overall it is still a very respected 25,400 contracts traded for the by the end of November this year, last month. Okay, so by and by you can see that the volume has been climbing. Okay, and we can see that the volume has been, of course, have a lot to do with what happened post Thanksgiving because of that Omicron news that hit the market. Now, these are the trading hours. Like I said earlier on, the trading hours is actually very, very advantageous for people based in Asia because the time lapse between Euro trading hours and Asia is actually a lot better than Asia versus the US hours. Okay, now now they have gone off the daylight savings, so now we are basing on the CET, which is the Central European time. You can see that on the chart here there is an equivalent for CET relative to Singapore time as well as Malaysian time. Okay, so you can see at 1 a.m. when they started trading, it's only 8 a.m. Singapore time, so it's actually very ideal. Okay, so by the time they finish trading at 2 p.m. their time, of course it ends here at 5 a.m. Singapore time, but the bulk of the trade, okay, the regular trading hours is actually captured very well within the Asian trading hours. So that explains why the interest from Asia. Okay, overall the market is open for more than 20 hours a day, so the liquidity there is actually very, very good. Okay, so now I'm going to share with you what I think the market is doing going forward. Okay, so of course we're going to look at the market from a higher time frame. I'm going to show you this. This is the cash index for the Euro Stock 50. The reason why I'm showing you this is because the futures contract do not have such a long historical continuous chart. I think we want to take our bearing from the cash index. So I'm showing you the monthly cash index. This is again the Euro Stock 50. You can see that the market has been going up the whole of this year. Okay, and last month in November, the market actually traded a high of 4,415. Now this is very much in line with the previous high here. There was a high here at 4,411.6 thereabout. Okay, you can see it was very, very close, and you can see that the market is getting a little bit cautious as it goes towards the all-time high. Okay, the all-time high of course is at 4,572 in the cash index. So the market has actually reacted to the downside last month. Okay, this month we are seeing some kind of a rebound, but so far it is an inside bar, meaning to say that the high this month has not even challenged the high of last month. Okay, again, that in retrospect is also respecting the previous high. So going forward, the market upside is actually becoming very limited. So if you are still long in equity index in the Eurozone, okay, just do understand that technically speaking, the market upside is getting very limited. Okay, now if this thing follow through, now you can see that there are boxes which I draw, and this is just my way of seeing where the market contest for dominance actually take place. You know, there's always a perimeter in which buyer and seller will actually fight for control, and this is the area of the contest itself. Now that the price has left this box, it means that the buyer for the time being is winning the game. The seller now are in retreat. Okay, but things can change very fast because you can see that previously last month you can see the high of 4,415 has been traded, and the market actually closed on the low side of the November's range. This month we only have 9 days of trading, so it's still very early. Okay, but I think this month is likely to see an inside bar. Okay, so do watch out for this move, because what's happened, this will lay the groundwork for what's going to happen in the new year. Now this is the weekly time frame, again based on the cash index. Okay, you can see that the market here, you can see it's a lot clearer. Now the market has actually gone up, test this high, and pull back. This week we can see that the market has been trying to go back up, and you can also notice that when I join the low and this low here and extend it all the way forward, okay, 3 weeks ago the market actually attempted this support line here. Okay, of course this line is an imaginary line that we draw. The low was 4,027.43 in the cash index. So far the market has respected this support line. Okay, what we also want to know is that in terms of the momentum, we have been seeing a divergence. A divergence means the market is going one way, where the technical indicators like a momentum indicator like this is an RSI. Of course, for those who are not sure what an RSI is, it's actually a relative strength index where we measure the momentum in a marketplace. In a regular market, in a normal market, if the price is going up, the momentum here should be continuing to rise. But what we are seeing here is that as price hits higher, the momentum is actually showing lower peaks, and that is always a classic sign of the market not being able to sustain, okay, at a higher level. At some point the market will have to pull back. Now whether this pullback will result into a free for all, we do not know. Of course, again, we will have to depend on what happened next. Things that can go wrong will go wrong, not only on the economic front. Of course, we already know that it's going to be policy divergent. If this thing continues into the next few months next year, I think investors will start to shift their capital from Eurozone to the United States. So it's definitely a negative for Euro stocks, okay? So do watch out for that. Of course, on the geopolitical front, right now the most sensitive thing is the tension between Russia and Ukraine. Now, if that end up as a shooting war, all bets are off, okay? And that will be a negative for European stocks because they are right in the front line, okay? So do watch out. There is a very little upside potential, but a lot of downside potential, okay? So long as the price do not close this week or in the subsequent week, do not close below 4,027, I think we are fine. But anytime we close below this level, that will be the first sign that something is not right, okay? That means to say that the long-awaited correction that we have been all talking about, okay, may actually happen very early next month. Correct, next month, okay? And if the price goes below 3,473, okay, the entire bullish outlook here will flip to a bearish outlook, okay? So do watch out for this particular technical points here. Now, this is the futures contract itself, okay? You can see that this is not the micro because the micro is only launched a few months back, so we do not have enough historical data to actually show you. So I show you the regular futures contract for the STOXX 50, Euro Stoxx 50, and you can see that this line is still very much in play. However, you can see that there was a period here, okay, the market actually went below this line, but it didn't close outside this support line, okay? It actually went back in again. So this is the area whereby I think this is a fake move, okay? And prices has been rebounding since. And the last few days, the market has been going up based on the fact that the Omicron may not necessarily be as lethal as the Delta variant. So that's the reason why the market has rebounded, because people fear it's not as fearful as what they originally thought. Because when you do not know, when you do not understand something, okay, of course the fear factor is going to be magnified. Now, as the days goes by, it seems that reports coming in is that the Omicron variant may not necessarily be more lethal, although it is more infectious. Okay, so that's the reason the market has a collective relief rally. Okay, again, you can see that this is of this afternoon. This is yesterday. Yesterday we have a high of 4,289 on the futures contract itself. Okay, and the high so far is 4,409.5. So we can see that unless this high is taken out, I think there is a very good chance that we're going to lose momentum, and for the time being, I think we are seeing more potential to the downside than upside. Okay, the target is at 3,739 in the futures contract. Now, this is the 4 hours outlook as of lunch this afternoon, because that was when I updated my chart. You can see that overall, you can see that the market has already turned negative on the 4 hours time frame. Okay, and prices has hit a pocket of resistance. This pocket of resistance resides at 4,274 to 4,303. So this area is the pocket of resistance where it originated before we have a waterfall here. So now the rebound has moved back to this pocket and is meeting a lot of resistance. So last I saw, the price was a bit lower now. Okay, this is of course based on the micro index of the Euro Stoxx 50. Okay, so this is my outlook. The target for this move is just below 3,900. Okay. Now we turn our focus to the Euro to the DAX 30. Okay, again, I'm going to show you the cash index for the German index, and this is of course quite elevated. Now, if you remember the chart in the monthly for the Euro Stoxx, this one looks very different. Okay, when the market came off last year, it actually negate the entire bullish outlook. Okay, but now the bull is back. Okay, so it started from the low of last year in March. So the low, this point here is 8,255. Okay, the high traded so far is at 16,290. That's amazing. The market actually doubled in value. Okay, so you can see that at this current price here, right now the market is moving between these two lines, 16,290 and 14,816. So these two lines here is where I think the boundary of this market is. If the market does not break out of these two boundaries, I think we are still within a consolidation phase. Okay, so by and large, this is still a bullish outlook. Okay, however, we can see that the upside is actually quite limited if you use the Euro Stoxx 50 as a guide. Okay, this is the weekly time frame again in the cash index. we are seeing the same thing in terms of divergence between the price action and the RSI itself. The momentum is telling us the market is going new high, however the index is not following through. So this is a classic divergence which actually precedes a counter trend move. Okay, so again we can see that the market actually have a big fall off, and of course this is where the post Thanksgiving when news of the Omicron actually hit the market have a very sharp pullback. Since then the market has been on the rebound. However, the rebound is not as robust as what we saw in the Euro Stock 50. The market has rebounded back 50%. It's a lot lesser than what we saw in the Euro Stock 50. Yeah. So technically, looking at it, I would say that DAX 30 is actually, on a comparative basis, is actually not as bullish as the Euro Stocks. Now, this is the daily time frame. This, of course, reflects the futures. This is the mini futures. Again, the reason why I'm showing you the mini futures is because the micro futures contract for this particular index do not have enough historical data, and I want to show you a lot more. Okay, so you can see that the volume has not catch up. The market have a fall here, and the volume spike up. But as the price recover, you can see that the volume is not catching up. So this is an inherent weakness, technically speaking, okay? Because the uprise here is not supported by a rise in the corresponding volume. So technically, this market, the rebound here may not be sustainable, okay? So far, we can see that the high is at 15,893. I'm sorry, 15,843, okay? So this is a counter trend move. Okay, the high is at 16,296 in the mini contract, and the low traded was 14,915. Okay, so you can see the market right now is within this boundary here, and the price at this current level may not necessarily be able to go much higher. If it's higher, I think it is a selling opportunity. Of course, this is my personal opinion, and if the price ever break 14,406, the entire bullish outlook here will flip to a bearish outlook. Okay, so do look out for this. So this is the 4 hours outlook for the same micro e-mini contract. No, sorry, micro futures for the DAX 30. Now there's a pocket of resistance. Okay, unlike the Euro Stock 50, the market has already hit the pocket. Okay, however, on the DAX 30, you can see that the market just was shy of this pocket of prices, and these prices, the reason why I highlight this area is because this is where the waterfall actually happens. Okay, so prior to this move, there are a lot of selling orders here. So the market now is respecting this range of prices here. So if the prices ever goes back into this pocket of prices bounded by 15,858 to 15,963, I think this is a selling opportunity, and this is possibly a very low risk trade because the stop is just going to be above 16,052. Okay, so this is my outlook for this micro DAX 30. Okay, and this move here has a potential to go all the way down to 14,400. Okay, so this is the outlook for these two index. Now again, we want to see the major drivers, the major advantages of trading this major index here. Okay, here we have the Eurozone as a whole. Okay, is the second largest economic bloc in the world. Obviously, we want to be aware of what's happening in Eurozone, and of course, Eurex is the Europe premier derivative exchange based on volume. Okay, Ken has actually mentioned that Eurex is actually a very successful exchange. When we look at the whole Europe, okay, we can see that Eurex is actually the biggest derivative exchange based on volume. We can also see that the micro equity index, 1/5 the size of the regular, 1/5 the size of the mini contract, and 1/10 the size of the regular contract. So you can see that this micro equity index is actually designed, okay, for you and me, because it allows us to have many different play on strategies. Previously, let's say you trade the mini contract or even the regular contract, which is going to be very unaffordable from our perspective because it requires a lot more capital outlay in terms of margin. Now, when you compare to the mini contract, it is 1/5 the contract size. Okay, so you can see that in terms of margin requirement, you don't need so much margin tie up to participate in this product itself. Now, with 1/5 the capital required, you can actually avail yourself to this contract here. And of course, the opportunity that's going to be thrown up by what's happening in the Eurozone. and it's very, very cost effective. You want to check with Phillip itself how much the commission for this, but I'm sure it's going to be very, very competitive. Okay, this has been ongoing for some time. Cost of trading has actually been coming down because it's a very, very competitive markets here. Okay, so in terms of cost wise, because of the liquidity that is very, very deep, it narrows down the bid and offer prices. It also lower down our trading costs, and of course the commission that you need to pay for trading this particular product is also going to be very affordable. Okay, now the other advantage that you want to take a look is that of course now we have extended trading hours, and every day the market is open for more than 20 hours, more than ample time for us to participate in this market. Whether you're a day trader or whether you're a swing trader, okay, this market will have a lot to offer you. And the timing, the market opening timing, okay, for these products is actually very well suited for people in Asia. Okay, now they come to the point whereby I will take your question if you have any. Serene?
Oh, thank you, Daniel Ang, for your presentation. So anyhow, if you guys have any questions, you guys can type it in your question box, and then we will answer your questions. So let me make some presentation on myself. Okay. Okay, so no matter you are our client or not, we are offer free one-to-one coaching sessions, free seminars and webinars, and free account opening. So for the free one-to-one coaching sessions, the key topic that we are focusing are introduction to futures trading, product knowledge, platform coaching, and charting systems. Besides that, we also will conduct free seminars and webinars regularly. But since we do not have organized seminars at the moment, so we will be focusing to provide more live webinars with different topics for you guys to join. So next, this is the next sections for our webinars, which is the palm oil outlooks, which is on next Wednesday, 7:30 to 8:30 p.m. And for sure, you guys also can follow our Facebook page to join more upcoming webinars. So here is the QR code for you guys to scan. So I will let it here for 1 minute. So you guys can scan the QR code to join the next webinars. Okay, so I guess you guys have been done. So next, I want to proceed that we have success. So you guys, if you guys still have any questions, that anything that you guys not sure, you guys can put it at the question box, and then we will answer your question accordingly. So next is our online account opening. So we have successfully launched the first futures trading online account opening in Malaysia. So you can open futures trading account online with no hassles. So if you wish to open futures trading account online, feel free to visit our website and you can scan the QR code and it will directly link you to the account opening form. If you need guidance on online account opening, please do not hesitate to contact us. So for free account opening, you will receive a complimentary mobile and desktop platform at no cost and access to wide array of products including global futures commodities, interest rate, indexes, and metals. Okay. Okay, so there's a question for Mr. Daniel. So there's a person asked that how would the US equity market impact on the Euro market and Germany equity market?
Okay, by far, the biggest equity market is still the United States. That is without doubt. Okay, so what happens in the States will definitely have a global impact, not only on the European equity index. It will be global. It will be worldwide. Okay, so of course, while we keep one eye on the European index and what's happening in the Eurozone, we definitely want to keep the other eye open on what's happening in the States. Okay, because if the biggest equity markets, have any kind of adverse move, it's definitely going to impact the rest of the world. So yes, it will have a positive correlation. Meaning to say, what happens if it's down in the States, it will be down everywhere else. Okay. So, however, in Eurozone, they have their another sets of different driver. Like I mentioned earlier on, we have the policy divergence between the ECB and the Federal Reserve. That will be one major driver driving equity index in the Eurozone. And of course, we have the Russia-Ukraine tension going on, and that's again very much going to impact European more than the United States, because at the end of the day, if Russia actually cross the border into Ukraine, it's definitely going to elicit a more direct response from Europe rather than United States, because at the end of the day, United States is across the Atlantic Ocean. Okay, they are not going to be physically affected. But I think if the US actually are drawn into this conflict, then all bets are off. Is there any other?
So thank you for the so far. Yeah, thank you for the question. Thank you for the answer, Mr. Daniel. So there's another question is asked about the brokerage part. Anyhow, for the brokerage, we will ask our representative contact you guys accordingly. Okay, so I think that's all for the question part. So now I will move to the introduction to our trading platforms, which is Phillip Nova, which commonly used by our client to access the global products. So for the desktop version, is a web-based platform, but for the mobile versions, you can trade using the Phillip Nova applications, which allow you to trade anywhere and anytime. So next will be our ongoing promotions. So this is the latest promotion with our Phillip Star traders. So you can start accumulating points, which is today, and get reward with exclusive prize worth a total of RM 50,000 and cash reward up to 4,000 by trading futures and share CFD from 1st of July to end of this December 2021. So you guys also can connect us now on Facebook, LinkedIn, or YouTube by searching Phillip Futures Sdn Bhd and Telegram by searching Phillip Futures. So do like and subscribe our page if you haven't. We will consistently update our event, promotions, announcement, and market news. So our recorded video will be uploaded on our YouTube channel too. So if you guys have any inquiries, please do not hesitate to contact us, even through calls, email, website, live chat, or Facebook messengers. So our representative will contact you as soon as possible. So if you have any questions, do contact us, and we are happy to assist you. Last but not least, the opportunity to join it. Check out on our latest promotions and grab that. So we'll end the session. Thank you.
And thank you for attending.
Without that, I